So today we're going to review a trial balance, the purpose for a trial balance, how to prepare a trial balance, and what to do if a trial balance doesn't balance. So on a trial balance, what we're going to do is we're going to list out all of the accounts and their balances in either a debit column or a credit column, depending on if that account has a debit balance or a credit balance. But these accounts have to be listed in a specific order. So the way that we're going to list these out is assets, then liabilities, owner's capital, owner's drawings, revenues, and expenses. So that might look familiar because that is the expanded accounting equation. Right, so we're listing out our accounts on a trial balance in the same order as the expanded accounting equation. So we're going to list out all of our assets, then our liabilities, and then our four pieces of owner's equity, which are owner's capital, owner's drawings, revenues, and expenses. So assets have to be listed in a specific order as well. And we call that the order of liquidity. So that means how quickly we're going to turn that asset into cash, or how quickly we can use up that asset. So we also list assets in order of liquidity when we're dealing with a balance sheet, right? So cash is always first, then you normally see, then after cash, you normally see accounts receivable pop up. Right? It's how quickly we can turn that asset back into cash. So knowing the order of liquidity will be important for both a balance sheet and here when we're preparing a trial balance. So there's 3 steps that your textbook outlines for preparing a trial balance. And quite honestly, they lump a lot into this first step. They say, list all the account titles and their balances in the debit or credit column. That's the majority of the work when preparing a trial balance. So this is when we list out each individual account that has a balance, that has any amount of balance in it. And then next to that account title, either in a debit column or a credit column, we would put the amount of the balance. And this is where knowing accounts' normal balances will really come into play, right? So your assets, owner's drawings, and expenses, those will all be debit balances, while your liabilities, capital, and revenue will all be credit balances. So knowing the difference between which accounts have normal debit and normal credit balances will be crucial when we are preparing a trial balance. So that's step 1. Step 2 is we're going to add up all the numbers in the debit column and then add up all the numbers in the credit column, because we want to know our total debits and our total credits. Step 3, we just want to see that those amounts equal each other. So just like when we are dealing with a journal entry, we always need our debits and credits to equal. And it's exactly the same here on a trial balance. Now, the good news, if you prepare a trial balance properly, your debits and your credits are going to balance. They're going to equal. If they don't equal, we have a few tricks to look for later on in this review. But that's when we know that we need to go back and double check some stuff, right? So your 3 steps, you list out all the accounts and their balances, you add up your total debits, you add up your total credits, and then we just make sure that our total debits equal our total credits. So now with all of that information, we can now look at preparing a trial balance. So we have a list of accounts here, and we need to take all of this information and prepare our trial balance. But you can see that the accounts are jumbled up, right? We don't have them separated into asset accounts and liability accounts and revenue accounts. They're all mixed together. So we should go through here and figure out which accounts would go in which order, right? Which accounts are assets, which accounts are liabilities. So in that way, when we're preparing a trial balance, we aren't going to miss any potential accounts. So if we start off with service revenue, well, we know that that's a revenue account, so we can put an R next to that one. Salaries expense, that's an expense. Then we have our owner's capital, and then we get to equipment. And equipment's the first one that we really need to think about here, right? So equipment is machinery, is a delivery van. Those are assets. So equipment will be listed along with our asset accounts. Now, unearned service revenue. This is when a company gets paid before they do any work. So they owe their customer future services. And since they owe their customer something, they are liable for those future services, and unearned service revenue is a liability. Now, accounts receivable. Accounts receivable is when a customer owes us money, when we will be receiving money in the future. And that's one of our asset accounts. Cash, we talked about this a little bit earlier. Cash is an asset, and it's the most liquid asset, so it's always listed first on a trial balance. Then our notes payable. Notes payable is a loan from a bank, so we will have to pay this money in the future back to the bank. So that's a liability, right? When we see the word payable, we can be thinking liability. Utilities expense, that's another one of our expenses. Same with advertising expense, right? These are just different types of expenses that a company will have throughout a month. Now, owner's drawings, that will get listed after our owner's capital. Then we come to supplies. Supplies are things like office supplies, so paper and pencil. And supplies are an asset. Now, rent expense is another one of those expenses. And then we come to our last account here, accounts payable. So this is when we owe a supplier or someone that we purchase something from on account. So we owe them money in the future. So we are liable to pay them. So it's a liability. So now we can look at this table while we're preparing a trial balance, right? And when we're looking at assets, then we know, okay, we have equipment, accounts receivable, cash, and supplies. So we know that we should have 4 assets that we need to order in the order of liquidity. So we have all of that information still in the upper left, and we will prepare our trial balance. So you'll notice at the top of a trial balance, it's almost similar to what we see on financial statements. It's a company name, and then trial balance to let everyone know that this is a trial balance, and then a specific date. So we're preparing this trial balance on December 31st, 2020. This is not for the month ended December 31st or for the year ended. These are the balances on a specific date. So we are going to list our accounts now. Based off of the expanded accounting equation, the first type of account that we need to list are assets. We talked about earlier how those assets have to be listed in order of liquidity, so how quickly we can turn them into cash, which means cash is going to be the first one that we list. And we were also talking about earlier how to know whether to put it in the debit column or the credit column. So assets, owner's drawings, and expenses will all go in the debit column. Liabilities, owner's capital, and revenues will all go in the credit column. So cash is an asset, and we list the $15,000 balance under the debit column. So then we're looking for the next most liquid asset. So we're down to now just equipment, accounts receivable, and supplies. Well, we know that equipment is something that the company is going to want to keep long term. So that's not going to be a very liquid asset. So we're down to accounts receivable and supplies. Accounts receivable is something that we expect that we're going to collect within 30 days. So accounts receivable is very liquid, so we're going to put that one next. So accounts receivable and its $8,000 balance goes under the debit column and is listed after cash. So after accounts receivable, we are going to have two more assets that we need to list here. We have equipment and we have supplies. Again, we said that equipment is something that a company is going to have long term. So the next one that we're going to list is going to be supplies, because supplies are things that we're going to use up faster than equipment. So supplies, another asset, and the $5,500 gets listed under the debit column. Now, we have one asset left, so we list the $35,000 balance for equipment after supplies. So we have all of our assets listed on this trial balance. Now, unlike a balance sheet, we don't actually separate our different types of accounts, right? On a balance sheet, we separate our assets, and then we have a category for our liabilities, and then we have a category for our owner's equity. On a trial balance, we list them in the order of the expanded accounting equation, but we do not separate or label the different categories of accounts. So right after you list out your equipment, then you're going to have to list out your liabilities. So we have three liabilities here. When we look up, we see unearned service revenue, notes payable, and accounts payable. The first one that we're going to list is accounts payable. So we're going to just list it from greatest to least, right? So accounts payable had the biggest balance of our three liabilities, so that one gets listed first. And you'll notice that the balance for accounts payable goes over in the credit column. So that $12,000 balance in accounts payable is our first credit listed on this trial balance. After we list out accounts payable, we will list out the next largest liability, which is our notes payable. So whenever we are loaned money from a bank, we have a notes payable here of $8,000, and that $8,000 is in the credit column. And then our last liability the $6,000 balance in unearned service revenue. So we have our three liabilities listed out here. So after liabilities in the expanded accounting equation comes your owner's capital. So we take a look back at all of our accounts that we have in the upper left, and we see that our owner's capital is $45,000. Now, capital, just like liabilities and revenue, will be a credit balance. So owner's capital goes over on the credit side of this trial balance. Then after owner's capital comes our owner's drawings. Owner's drawings, we see that we have a balance of $16,000. Again, drawings along with assets and expenses are debits. So we'll list out our owner's drawings and the $16,000 balance under the debit column. So we have our capital and we have our drawings listed out here. So our next piece in the expanded accounting equation is our revenue. So we take a look up at all of our accounts that we have listed, and we have one revenue account. We have service revenue for $35,000. Just like we said earlier, revenues are credits. So that $35,000 will go over on the credit side. So we don't have any other revenue accounts. And now we're just left with our four different expense accounts. So we're going to list those expenses in order from greatest to least, just like we would on an income statement. All right, so the salaries expense is $15,000, and that's over on the debit side. Because again, assets, drawings, and expenses are all normal debit balances. So salaries expense is $15,000. The next largest expense is rent expense at $6,500. Then we have our utilities expense of $3,500. And finally, our advertising expense of $1,500. So this is what I was talking about earlier with those three steps of the trial balance. We just completed step 1. Steps 2 and 3 take a lot less time, right? So step 1 is truly writing everything out on your trial balance. So we listed out every single account and their balances. And we have our asset, drawings, and expense accounts all listed under the debit column. And then we have our liabilities, owner's capital, and our revenue accounts all listed under the credit column. And notice how there is no break in between the different types of accounts. Our assets flow right into our liabilities, which flow right into owner's capital, and so on. Right? We just list out all of these accounts and all of their balances. So step 2 is to add up our debit column and our credit column. So if you add up all of your debits and all of your credits, we'll see that our debits add up to $106,000. Now, if you're preparing a trial balance and you see that your debits add up to 106, You have to be hoping that your credits add up to 106 as well, right? Because we want our debits and credits to equal. So we then add up all of our credit balances, and we see that those also equal 106. Now, there are a few tricks that we'll talk about, just in case those don't equal. But if you are preparing a trial balance and your total debits equal your total credits, chances are you've done everything right. Now, there's still the opportunity of making a mistake somewhere and having your debits and credits equal. However, I would not harp on that too much, right? If your debits and credits equal, you'll be able just to move on from your trial balance. So that's what your completed trial balance would look like. So let's talk about what happens when they don't equal, right? If our credits came out to be 105,000 instead of 106,000 in that example. The first step, just make sure that you didn't make a math error, right? Make sure that you didn't just add up your debit column incorrectly or add up your credit column incorrectly. You might have flipped a few numbers. Just check to see if that was the case. If your math all looks good, then we need to think about the difference between our total debits and total credits. So if you take your total debits and subtract your total credits, and that difference is divisible by 2, then you need to try to find a balance that's equal to half of the difference to see if it's been entered into the wrong column. So, for example, if your total debits equal $5,000 and your total credits equal $4,000, we have a difference there of 1,000. So we would be looking for a balance in our trial balance of 500. And that 500 balance might have been put into the wrong column. So that's one trick to look for if the difference between your total debits and total credits is divisible by 2. Now, if the difference is divisible by 9, we need to look for a transposition error, right? Instead of putting a balance as $12, you put it as $21, right? We just flipped around a few numbers. So that is something that we'll look for if the difference between total debits and total credits is divisible by 9. Now, let's say all of the math was correct and the difference is not divisible by 2 and it's not divisible by 9. Then what do we do? Well, that's when we have to go back and look in the ledger or look in our T accounts and try and find an error there. So that would have meant that the balance that you had for your account is just incorrect. So if we take a look back at our trial balance, we assume that our cash balance of $15,000 is the correct amount. But you might have made a mistake when working through your ledger, working through your T accounts, and coming up with that $15,000 balance. So if none of those other tricks work, we need to look at the ledger or the T account for cash or accounts receivable or whatever accounts might be incorrect and try and find an error there. So those are the 4 steps in case your debits and credits don't equal. Now, one last piece. Why do we even prepare a trial balance? Well, a ledger is going to be a book, right? There's going to be pages and pages and pages showing all the different balances of your accounts. Your T accounts could be over pages and pages as well. There's going to be a bunch of different numbers there. So we prepare a trial balance because it's going to make preparing financial statements so much easier, right? Rather than looking through all of the different pages of a ledger for the different balances, you can just look at a trial balance and see all of the balances of your accounts. So if we were to be preparing an income statement, we could just look at the bottom of a trial balance and see, well, there's our service revenue and there's our 4 different expenses. Rather than flipping through page after page after page of a ledger, trying to find those balances. So it's just a one-stop shop for balances. So in that way, when we're preparing financial statements, things are a little bit smoother.